Hi, welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Nick Gogerty. Nick is a partner at Thoughtful Capital Group, and prior to that, he was a senior business analyst at Bridgewater, the largest hedge fund in the world. Nick is the author of a very interesting book called The Nature of Value. Nick's got a very wide knowledge base, and I'm excited to ask him 5 good questions. All right, welcome back, everyone. Our guest today is Nick Gogerty, who's the author of The Nature of Value. Hey, Nick, where are we talking to you today?
I'm in Greenwich, Connecticut, kind of one of the hedge fund capitals of
world,
the world. Yeah, exactly right. There's London, New York, and Greenwich.
Nice.
Yeah.
Well, I'm really excited to talk to you today. I have to confess that, I always ask authors at the end of our interview, what's a book that they feel is underrepresented out there and that they think should have more publicity and should be more widely read. And I have to tell you that your book is my call for that question.
Well, that's quite a compliment, Jake, because I see quite a stack of books behind you. So thank you.
Yeah, you're welcome. So let's jump right into our 5 good questions. Question number 1. And I learned an entirely new term in your book.
Okay.
And I don't know if you made it up yourself or if that it's come from some other literature, but I really enjoyed the thought of it. And it's this term, INOS. Is that pronounced correctly?
Yeah, like short for innovation. Yeah, I did invent the term, and it's just a concept. It's a unit of information. Dimensionless unit of information, like a bit or a gene or something else, but it's the unit of innovation in companies. So, yep.
So how's that help us understand the world better?
Sure. It's a way of thinking about more broadly about innovation. When most people think innovation, they think a new product. There's a widget or whatever. And really, innovation comes in many, many forms. It might be how someone manages their cash flow. An innovation that was huge in business that we forget now because it's taken for granted was double entry accounting, right, from the 15th century Italy. Exactly. So, innovations come in multiple forms, and so once you understand that and you have a broader concept of innovation, and you understand that innovation is just a unit of change or adaptation, you look at a company in a broader way, and you can say, okay, what is this company doing interesting and innovative beyond just product? And one of the things in the book is that innovations get broken up into 10 types of capability using the model from Dublin. And so what you can do is you can look at these and say, yeah, the company has an interesting product. It's got an interesting brand. Oh, it's got interesting distribution. So, for example, like Coca-Cola, I try to use really easy and familiar companies in the book. Coca-Cola is as much a distribution innovation company, in terms of its core moat as anything else. So it's very important to understand that innovation isn't just just new widgets.
Yeah.
And rarely does a new widget last. Someone will engineer a better widget tomorrow. So you need as many types of innovation as possible to defend the moat and defend the margin.
That's a great segue for question number 2. And that in the book, you make this interesting observation that moats don't appear in newspaper headlines. And that, so really, I guess the first question there is, where do they come from then?
Yeah, I'll respond to that with the following. One of the observations in the book from an old article in Fortune is that I think it's like 1 or 2% of companies can maintain a greater than 15% return on capital over 15 years or something, right? It's very rare. And yet you never see a headline on, the Wall Street Journal headline, hey, blah, 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 X company just had return on capital 20% for 20 years. Let's throw a celebration. Those are quiet things. They're quiet advantages. And those advantages come from having the multiple innovations that customers value that are unique over time. And so really what you're looking for, and I call the metrics like a return on equity or return on invested capital, if those are long-term and sustainable, those are effectively like the shadows of the innovation, right? The innovation creates all these things, the multiple types, and then they show up on the balance sheet. Now, the other part of your question was the cycles of innovation and the length, I believe. Is that correct?
No, not quite. It's kind of related to that, but it's how are they only easy to spot when they're already expensive and or maybe dying? Like, how do How do you get out in front and find that moat when it's still mispriced?
Well, I think the first way to look for it is to see if it casts a shadow across the cash flow statements and the balance sheet and the income statement, and that effectively is what looks like high or interesting margins above super normal economic margins. So it is a 15% or higher, greater ROE over time, and then try to figure out what's causing that. And sometimes the company will articulate that, and sometimes they won't because it's like a trade secret. One of the most interesting examples I think I mentioned in the book is, I actually talked to an analyst, one of the first guys who researched Walmart. And he asked Sam Walton just before the IPO, they were a bunch of money guys from the East Coast. So he goes out to Sam Walton and is like, so when are you going to bring Walmart to New York and Boston, in real places? And Walton says, we're not going there. This is in the 70s, obviously. Yeah. And, the analyst couldn't believe it because he's like, oh, these are the big cities. And what he didn't get until later on, he admits, was that what Walton was articulating was his strategy. He knew where he made money, and that was the quiet strategy, was going in and dominating a small town and owning a small market. And so unless you really get retail and you get thinking about the end customer's choice set, it's tough to understand those moats. So the way to get and understand a moat is to think like a customer and think about your choice set. So what's going to drive my behavior? My first degree is cultural anthropology, so you study behavior, sociology, etc. So it's like, think about the end customer, if it's a business or an individual, and say, why would I make this choice, and how tough is it to shift? So why would I drive to a Walmart because it's in my town, or how tough is it for me to shift, my use of Microsoft Office, or how tough is it for me to shift, or why would I want to shift X, Y, and Z? So the weird thing about moats is, instead of thinking like an analyst, the best thing possible is to try and think like a customer. And then think, all right, how big is my choice set? How much can I switch? And if it's really painful to choose another option, that pain of switching probably shows up in a margin somewhere. It's an advantage.
Yeah, that makes a lot of sense. If you can't substitute out, if you can't scratch that itch in a different way.
Yep, exactly. Then you're gonna.
They kind of have you.
Yeah, well, exactly. You're gonna pay up, and obviously, and then that shows up, over time in the cash flow statements and the balance sheet as extra and larger margins and higher returns on capital. But the important thing for the investor is to really understand where the moat is. So that you can see if management is drifting away from it, and understand if there's another innovation that's going to undercut it. So, and it might not be a techie software innovation; it might be a regulatory change or something else. So, first you have to be able to measure the moat and see that it's there, and then understand what's supporting it and how many things.
The bus industry probably didn't see Southwest coming.
No, exactly right. Because they were looking, to their nearest competitor, and that's, a great point. Is one of the things in the book is substitute products may not come from the current industry. So the Yellow Pages got nuked by Google. Never could have seen that coming. Well, they may have, but it was darn tough. Let's say that.
Yeah.
To respond.
All right, let's do question number 3 now, and this is a favorite of every value investor about See's Candy.
Okay.
We all dream of our paying $25 million that's going to spin off over $1 billion over the next 40 years.
Right, and be fairly easy to manage. Right, not many headaches, not many threads.
No,
I think the lessons in See's Candy. Is that where you want me to go? Or
just the question is, how does your observations in Nature of Value help us understand the See's Candy as a business, as an investment better?
Yeah, there are a couple of ways there, and I was actually going to throw See's Candy in the book, but my editors and others said that's ground's been covered. So I'm like, okay. There are a couple of ways to understand that. One of the most interesting is Buffett will say, and Menzies will say, time is the friend of a good business. And See's Candy obviously is a case in point. And one of the most interesting things about See's Candy, one of its 10 types of innovation, is brand and customer experience that they deliver, right? And one of the interesting things is, how does inflation work on that moat? and it works very, very well. And as mentioned in the book briefly, that moat works based on relative value. I can go get a Hershey's chocolate bar for maybe X dollars. My perception of value as an end customer, because of my C's experience and branding and quality, says I'll be willing to pay this much more margin, right? I value that product relative to the other one. So as inflation moves along, my relative value, which was probably created years ago fairly cheaply in terms of brand and experience, scales with inflation. So I have a very, very high return on that moat, if that makes sense. That's one of the that's one of the ways. The other real interesting thing about See's Candy, I find, is, and this has to do a lot with thinking, is what I call like negative thinking, and it is what hasn't See's Candy done, right? They never went to the East Coast. They never did these things, and that to me reflects a lot of discipline. Because and obviously that's part of Buffett's capital allocation. They're spinning off all this cash flow, and I'm sure there was a manager there who said, "Let's go to the East Coast, let's go to Mexico, let's go global."
Right.
Or there would have been an investment banker who says, "Hey, let's roll up 3 little candy companies, and we'll make mega C's." And that never happened. And that discipline of what didn't happen is quite interesting. They had a cash machine. It was spinning out a nice returns on equity. And there was probably experimentation around the edges, but there was never a let's bet the farm with all the cash. It was got a great machine here, just keep going with it. I find that really interesting.
Yeah, you could have done a lot of stupid things with that money. And, basically killed the brand.
Exactly right. Killed the brand or killed shareholder value by just being a bad allocator. One of the most important things is good managers should have 2 functions: owner operator and allocator. And many of them will think like an owner-operator. Then all of a sudden they're successful. They sit on piles of money, and they get the halo effect where it's like, oh, because I ran this great business, I can run another great business. So they'll go out and poorly allocate to another business, or they'll try to do bad things to the original business. So having those 2 disciplines, owner-operator and allocator, in one CEO is rare. And even, Buffett, he separates that role, right? He plays the role of allocator, and then he lets very clear lines of owner-operator go.
Yeah, no, I think that's huge. I mean, you read books like The Outsiders, Thorndike's book. Yeah. It really impresses upon you how big of a difference having a good allocator at the helm is for value. Yeah,
there's a serious discipline there to separating the emotional intensity of the business with, let's say, the cold rationalization of the allocator. Because it's very easy to fall in love with a company,
and want to grow it to the moon. And even if every store that you're adding is less and less profitable.
Yeah, or to save it, right? I mean, one of the toughest allocation decisions is not to throw money at something that's drowning. The first Berkshire Hathaway effectively died, and it was let go. If you'd been the founder of that company, very tough to do. I actually used a case study at Columbia where I teach Kodak as an innovation startup company. So I go back to the 1880s, and I say, here's Kodak in the 1880s, and I explain how it's a startup, and it got $5 million in capital, blah, blah, blah. And then I forward to the 90s, and I say, if you were the CEO, could you have done the responsible thing? And effectively killed film, but also just taken the capital and done the right thing and put it someplace else. Could you have transformed Could you have gone into Kodak as a senior manager and say, I'm the new CEO, and I think we need to invest in an insurance business, a soft drinks business. No, it was a film company, so they structurally got trapped into thinking what they were and destroyed capital. It went from I think 45,000 employees, a $45 billion market cap in real terms in 97, down to zero effectively in a couple of years. And it's tough, very, very tough. And I try to teach that to MBA students to be a good allocator and owner operator.
Yeah. So that's question number 4. And this has to do with, I think everybody understands survival of the fittest and how adaptation helps us helps nature keep a more robust system running. And it's obviously not that big of a leap to apply that to business thinking. So, but how do the speed of adaptive cycles of evolution help investors understand businesses better?
Sure.
I found that section really interesting, and I hadn't really thought about that before.
Great. Well, it's an interesting thesis. First of all, evolution is nothing more than a theory of change. There's selection, adaptation, and then amplification. Right? You survive, you grow, etc. And then there's more of that stuff. And so whether that process or theory of change is occurring in the ecological domain or in the economic domain, pretty much the same thing. Cycles are important for the following reason. Cycles indicate what the rate of, let's say, change is underneath something. So it's very important from a capital perspective because effectively a company has capabilities like an animal or a species. It can run fast, it can jump, it can do, etc. The question is, how long are those capabilities going to give you an edge over all of the other competing resources? And the interesting thing is that in a complex environment, be it an ecology or an economy, the rate at which you need to adapt or get new capabilities is different. So the railroad industry, regulated, slow to change, long development, long innovation cycles, right? So some of the biggest innovations were regulatory in the 80s. However, if you're in the cell phone market, development cycles are similar to like a mayfly in nature. They're 18 months, 9 months, very, very brief. What that means from a capital allocation perspective is your window on the future, how long that capability is going to last, is driven by those innovation cycles. So if I'm in an industry that has, development cycles that last 3 or 4 months or 3 or 4 years or 5 years, then I need an extremely high return on invested capital, extremely high returns to justify that, because I really can't fool myself into thinking, oh, this is a cash flow stream in perpetuity in 20 years. That's one of the false lessons that's taught in business school is, an equity has a perpetuity of cash flows, and that's not really. You should look at the capabilities and say, I can only see out. I work in an industry that changes, extremely quickly. How far can I see out? And then discount accordingly. Now, the weird thing is, if you fall in love with the growth and the speed of something, people actually severely overprice things.
Because all the cash comes up front.
Exactly, without realizing that, hey, there's a terminus there that's going to be extremely rapid. And that inflection point, who knows where it's at? Is it 3 or 4 years out? And all of a sudden, if you can only say that the cash flow is going to come for, let's say, 3 or 4 years, or let's say visible cash flow, and that there's this land on the other side that we can call, here be dragons, total uncertainty, then the factor, the return on capital you need goes extremely high. And so there's extreme mispricing in innovation and tech companies because of that. So it's I think the way to think about it, whether it's chip cycles. I have a section there on solar energy. So it's a very helpful way, I think, for the investor to discount accordingly. Like one of the companies I teach, I taught at Columbia, I compared Kodak's early days with GoPro, and I do a capability footprint. And I show that, GoPro is great, but they're it's nice. But from my capability analysis, I can see their future maybe 2 or 3 years out. Okay, for break even on capital, that 20 to 30%, and that's break even, right? This is not risk adjusted, so it's like, so I do an interesting case study on that.
Yeah, I like that. That's a nice temporal comparison there. I mean, they're effectively the same. Well, they're kind of scratching the same itch, so to speak.
Well, that's the thing. I in the case study, I teach Kodak as a startup company in the 1880s and 1890s, and show how they had this huge capability footprint over the 10 types of capabilities, and they're like the Apple of their day. Super cool, interesting to understand. And then they milked that for decades, and then it died. And then I lay the same framework and say, okay, here we have a new technology imaging company. It's called GoPro, floated, blah, blah, blah. Okay, what edges do they really have? Then we'll see if those edges will sustain the returns on capital. And they really, let's just say they don't support the current price of the shares.
Yeah, I would tend to agree with that.
We'll leave it at that.
So our fifth question, And this is, ETFs have become extremely popular in the last few years. They're probably a better mousetrap than mutual funds and just tax treatment. So how do this concept of clusters and the distribution of value in an industry, how is that reflected in ETFs? I found that a really interesting observation.
Yeah, and an ETF is an interesting, it's an interesting package, right? And it's a little bit like a nice, efficient package to get stuff in. The thing is, you really kind of need to know what's inside there and how those little pieces work before you buy them. And the thing is with an ETF, if you buy a narrow sector ETF, coal, solar energy, etc., you're buying all of the winners and all the losers. And so you're betting effectively not on an industry, which most people think, oh, I'm just buying this industry. You're also betting on the distribution of returns in that industry. And so, you have to assume, or you have to hope, that the winners overcome the losers. If we assume there's this natural attrition process where, larger, more competitive entities, or more capable entities come to dominate the market in the sector. So I think that narrow sector ETFs are very, very risky unless one can really get a handle on the competitive dynamics. Broad sector ETFs make sense because it's a cheap way for someone to buy the index. And in the book, I indicate that the safest bet for someone who obviously doesn't want to go deep in something is just to buy a broad sector index, and then you just let the economic machine take care of itself. But otherwise, trying to figure out the competitive dynamics of, let's say, 20 different companies in a sector, you're better off just finding what you think will be the most interesting company.
That's an interesting observation. So, like I said at the beginning, we always ask our authors a book recommendation.
Sure.
What do you have for us today? I'm excited to hear where you're going to take this one.
Oh, okay. My book recommendation hints a little bit at my interest in development of economic development. I studied sustainable economic development as an undergrad, focused on West African poverty. And so I think one of the most interesting books out there is by an author named Hernando de Soto.
Yeah.
And it's basically why capitalism won in the West. And it's fascinating.
A great book.
Yeah, because it talks about the importance of the rule of law, the separation of risk from the individual, and all of the soft technology that underpins economic development. One of the biggest things was the rule of law and the joint stock company are amazing inventions. Totally underrated, and in terms of innovations. The other reason I like the book is because De Soto's work on the concept of dead capital hints at a lot of what could be potentially hugely influential for developing economies, and the world's poor, in terms of the importance of the rule of law and the importance of good economic systems, the soft infrastructure.
Yeah.
If the soft
title companies and the private respect of private property.
Exactly. Those things all allow individual enterprise in the capitalist system to work. And without the soft infrastructure, the hard infrastructure, either doesn't get built, or if it does get built, it falls apart because no one owns it to take care of it. And so another huge economist I'm a big fan of is a fellow named Bjorn Lomborg, who looks at what are some of the cheapest ways to get impact in the emerging markets in the developing world for the world's poor. And good property rights and good business policies and procedures can make huge impacts for very, very little money. Soft infrastructure. So I recommend that book for people who really want to understand, effectively the soft infrastructure we all take for granted and how important it is.
Yeah, I was really impressed with that book, with the this idea that entrepreneurs could tap the leverage of their private property to generate enough cash to actually go and start the businesses that would then grow into become, bigger companies. It kind of explains why there aren't a lot of, huge conglomerates that are coming out of countries with poor property rights.
Oh, exactly. And I hint at that in the book. The other thing that's interesting is it showcases the U.S. when the U.S. was a third world country. right? We had
Right.
malaria, it just came out of a guerrilla war, 1790s, it's divided, it's 13 weak statelets effectively with no formal taxation system, and the country is effectively broke. It's on its second currency because the first currency, the Continental, blows up, and so you have everything that's wrong. And it's could have been a coup, right? Because it's run by a general. Washington. So everything could have gone wrong, and so the interesting story is about this third world, effectively in terms of literacy and life expectancy and culture, and how it became the U.S. is a fascinating story. It's a great book.
Great recommendation. Well, Nick, it's been a real pleasure having you on.
Thanks, Jay. Good to talk with you.
All right, take care.
You bet. Bye.